They've been nicknamed the Magnificent Seven. They're the world's biggest technology companies, and they're the main drivers of the gains seen in the US stock market. They're also the reason that it's difficult for investors to stay out of the US market.
If you want to invest in the US, there is going to be a lot more volatility. It just comes with the returns. If you're going for growth, they have all the growth companies in the world to pick from. Secondly, from a stability standpoint, when you look at bigger companies, right, in terms of market cap, it's very unlikely that a lot of these companies are going to fail. At the same time, if you look outside the equity market, they also have a very strong fixed income market, a very strong FX market as well. So all in all, just because of the kind of products that they have, it's definitely a place to put some money to work if you're looking for gains that maybe you couldn't get in the local market or your regional markets.
While the technology plays dominate the headlines, even the broader US market offers opportunities for investors.
We do see some pockets of value. We are still, in terms of positioning, still a little bit defensive. So you look at stocks like utilities. We think that as interest rates kind of come down towards the end of the year or next year, there should be a little bit of reprieve for them because they're interest rate sensitive stocks because of their dividends that they pay out. At the same time, when you look at some of the cyclicals, I think industrials have been doing really well, especially because of the infrastructure bill that Biden has put in. So they're really just kind of pumping a lot of money into infrastructure, right? So, and it's like, I believe, 2 or 3 trillion. So you would think that over the long run, industrials would tend to outperform a little bit, especially in times of uncertainty right now.
But analysts also caution that in the short term, the US markets may see some rough times ahead.
Even though headline inflation in the US, it has moderated, but core inflation, it still remains elevated, and that is still well above the Fed's target. So what's worrying is that oil prices, they have been on the rise on the back of supply cuts by OPEC and also projections of higher demand. And Russia pulled out of the Black Sea Grain Deal, which could lead to a renewed increase in commodity prices. So as it stands, I think that inflation still has a long way to go before it reaches the Fed's target. And because of that, the Fed will have to keep rates high for longer. So overall, if we combine this with the lofty valuations of US equities and also the declining earnings growth, I think that the outlook, it doesn't really look well for US equities. And the upside is limited by all these factors.
But despite the risks, interest in the US stock market has been on a rising trend among Singapore investors. According to Phillips Securities research, at the end of 2019, the trade in US equities was around 25% of Phillip Capital's total trade value. In Q2 2023, that proportion had more than doubled. Experts say that investors should be looking at the fundamentals of the US market for the long term.
We are almost at the apex or the peak of this interest rate tightening cycle. I think the probability of lower interest rates rather than higher interest rate is going to be quite high. The Fed, the expectations of the Fed cutting rates in 2024, it seems pretty high as well. So on that basis, investors of technology stocks or in the growth sector are thinking that, maybe now is time to move into the tech stocks, which is exactly what we have seen since the start of 2023. Of course, for now, since due to the big run-up, on a more near-term, short-term technical basis, I think there will be a pullback. There will be profit-taking in some of the US names, but as we anticipate the upcoming recession, I think tech stocks will be, interestingly, one of the good ways to hedge against this recession in any portfolios.
As for the talk of recession, investors are advised against overreacting.
It's not important to know that when is the recession is coming. What is important is we know that it has to come, because across business cycles, whenever interest rates are high and it's tight, consumers are pulling their belt tighter, corporates are doing exactly the same thing, then an eventual recession will come. But that doesn't mean that you have been so fearful about it that you are not going to do anything. It's the same as if you think that it's going to rain, but it's not going to rain. Is it going to stop you from going to work, right? Unless you work from home. So you need to stay invested. But there are ways to stay invested depending on your risk profile again, there are ways to do sector rotation, there are ways to diversify across geographies, may not be just in the US.
But ultimately, if you consider the US stock markets too volatile at the present time, it's always wise to diversify into other asset classes.
In this current interest rate environment, there are still many different ways to make your money work for you, especially when rates are this high. So I think one thing that investors can consider is money market funds, short duration bonds, or even the SGS T-bills, which are yielding around 4% based on the last few auctions. And I think more importantly, with the yield curve still deeply inverted and equity valuations high, I think that short duration bonds, they are the place to be for the time being, because the risk reward ratio for short duration versus longer duration bonds or equities is definitely skewed towards shorter duration bonds. And as for equities, I think that investors should focus on quality stocks. So for instance, stocks that have strong balance sheets, low debt ratios, strong earnings growth potential, and even competitive advantages like pricing power, as these companies, they tend to do well in an uncertain environment.